Assalamualaikum warahmatullah and welcome back to my video presentation. In this video presentation, we will be discussing the changes in accounting policies, changes in estimates, and prior period error, and how to record them. For this, we will be reviewing the provision by MFRS 108. Please watch this video with the handouts on illustration that I have uploaded in Putrabas. Specifically, in this presentation, we will be talking about how we deal with the effects of changes and whether the standard requires the effects to be recorded retrospectively or prospectively. For these two ways of recording the effects, we need to determine when to recognize the effects and how to recognize them. Before we talk about the effect of changes, we must first understand the meaning of accounting policies, accounting estimates, and error. As you will discover later, the way we treat the effects will depend on which event we accounted. Accounting policies are the specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements. Therefore, examples of policies will include the charging of depreciation. We can charge depreciation in full regardless of when the asset is acquired, or we charge the depreciation according to months of use. Another example is the model applied for investment properties, either cost or fair value model. The model applied for PPE, whether cost model or revaluation model, including the frequency of revaluation for revaluation model, be it every 5 years, 6 years, and so on. And also the percentage for allowance for doubtful debt. If there is a change in any of this, it will be considered as changes in accounting policies. Accounting estimate is an approximation of amount to be debited or credited on items for which no precise means of measurements are available. Thus, it is a result of an assessment. A simple example is the depreciation. Not only the depreciation itself, but the information to get to the depreciation is also an estimation. For depreciation, we wouldn't know exactly how much the value of our PPE reduced due to usage, but we do know that the value will not be as high as the cost anymore. So we come up with an estimation of their useful life and the residual value. Therefore, if the useful life of the PPE changes as time passes, that will definitely change the amount of annual depreciation, thus the change in accounting estimate. Similarly, say the useful life does not change but the residual value changes, that will also affect the amount of annual depreciation, thus it will be part of changes in accounting estimate. Therefore, a change in accounting estimate is an adjustment of the carrying amounts of an asset or liability, or the amount of the periodic consumptions of an asset that results from the assessments of the present status of and expected future benefits and obligations associated with assets and liabilities. The main point here is changes in accounting estimate is the result of us having new information or new developments, and accordingly are not corrections of errors. Now, how about a change in depreciation method? Is it a change in accounting policy or a change in accounting estimate? Now, this has actually raised a question, and there has been a discussion about changing the definitions of accounting policies and accounting estimates because of this. But for now, the change has not taken place yet. Adam Deller, a fellow chartered accountant who works with ACCA and currently a lecturer at University of Liverpool, explains the confusion. We know that the useful life is a clear estimation. However, when we talk about the change in depreciation method, it seems like we are talking about depreciation policy. And this makes sense, as it is the method chosen by the entity for recording depreciation. Yet, the depreciation method selected should represent an estimate of how the benefits will be provided by the asset. Therefore, according to Deller, the choice of depreciation methods should fall into the category of an accounting estimate, not an accounting policy, which I agree. Prior period errors are omissions from and misstatements in the entity's financial statements for one or more prior periods arising from a failure to use or misuse of reliable information. Now the fact is, whatever recorded in the financial statements are all based on the reliable information available to us. If we fail to use the information, definitely we will not record it correctly, thus misstatements, or we just not record it at all, thus omissions. If we fail to use the available information, that will be a mistake or errors done not on purpose, but at times we do have cases where the available information was misused. Thus whatever errors discovered later may be found to be done on purpose, but that is another story. Now, the standard is very particular when it comes to reliable information that resulted in the errors that could be considered as prior period errors in the standard. The reliable information must fulfill two conditions for the effect to be considered as error. First, the reliable information must be available when financial statements for those periods were authorized for issue by the top management. This has something to do with our later topic on events after reporting period. After reporting period, that is after the financial year end, say for example 31st December 2020, some events can still be taken into consideration to be recorded in that 2020 financial year, even if it occurs after 31st December 2020. But it must be before the financial statements are authorized for issue by the top management. Thus, in this case, the reliable information will only be considered if it was available before that cutoff point, because only then we can say that the error occurred for that financial year 2020, for example. Otherwise, the information is not relevant for that financial year and should only be considered in the subsequent financial year of 2021. And the second condition is, it could reasonably be expected to have been obtained and taken into account in the preparations and presentation of those financial statements. This means that the reliable information is there, available to us. We can have access to it and we can easily obtain it if we want to, no restrictions whatsoever. Thus we are reasonably expected to obtain it and take it into account in the preparations of the financial statements for that financial year. If the information was not readily available to us, then we will not be expected to obtain it. Such errors include the effects of mathematical mistakes, mistakes in applying accounting policies, oversights or misinterpretations of facts, and also fraud. Now let us test our understanding. Here we have 3 scenarios. Pause this video and take a moment to give a thought on what we have discussed earlier and try to match these scenarios with their appropriate events. Are they considered as change in accounting policies, change in accounting estimates, or simply a prior period errors? Have you made up your mind? Let me show you the answers. You got them all correct? Very good. Now let's continue. Other important definitions are retrospective application, retrospective restatement, impracticable, and prospective application. These terms are related to the way the standard requires us to record the effects of changes. Note that when there is a change, either in accounting policies or estimates or a discovery of error, it simply means that there could be a change in values. The question is, should the change in value be applied to future values only, or should it also be applied to values that have been reported in prior financial years? First, the retrospective application. The word retrospective means looking back or dealing with past events or situation. It is similar to the term backward-looking or backdated. Here, the standard defined the term retrospective application as applying a new accounting policy to transactions, other events, and conditions as if that policy had always been applied. In other words, whatever effects of the change, it must be recorded as if the change has been taken place in prior years, not just in the current financial year. Therefore, whatever values that we already recorded in prior years, all of them must be changed according to the new policy. Note that for retrospective application, it is meant for changes in policy. And then we have retrospective restatement, which means correcting the recognition, measurements, and disclosure of amounts of elements of financial statements as if a prior period error had never occurred. It is somewhat similar with applying the new accounting policy in terms of looking backwards. In this case, we look back to the time where the error occurred and try to correct the error. Thus, we also need to correct all relevant values in relation to that error until the current period when the error is discovered. Note that for retrospective restatement, it is defined in a way that it is meant for correcting prior period error. Another term that needs defining is impracticable. It simply means that an action is impossible in practice to be done or to be carried out. From the standard point of view, an action, in this case applying retrospective application or restatement, is considered impracticable or impossible in practice to be done when the entity cannot apply it after making every reasonable effort to do so. By this, the standard means the effects of the applications or restatement are not determinable, meaning we cannot, after trying our best, determine the effects of the changes, or the application or restatement requires assumptions about what management intent would have been in that period. Or application or restatement requires significant estimates of amounts, and it is impossible to distinguish objectively information about those estimates that provide evidence of circumstances that existed on the date or dates as at which those amounts are to be recognized, measured, or disclosed, and would have been available when the financial statements for that prior period were authorized for issue from other information. Another important definition is prospective application. Now, the word prospective means expected to be the specified thing in the future. The keyword here is future. Thus, the standard defined prospective applications of a change in accounting policy and of recognizing the effects of a change in accounting estimate as applying the new accounting policy to transactions or other events and conditions occurring after the date as at which the policy is changed, and recognizing the effects of the change in the accounting estimate in the current and future periods affected by the change. So if we talk about changes in policy, we apply the policy after the date of the change in policy, and if it is for changes in estimates, apply the effects in the current and future periods. Let us now look at how the changes should be applied. One thing that we need to remember, policy should be consistent. Because if you keep changing your policy, people might think that there is something fishy about your operation. In other words, the information that you provide in the financial statements might not be reliable. Remember the enhancing qualitative characteristics of financial statements in conceptual framework? One of the characteristics is comparability, and consistency is a way of achieving comparability. If you are not consistent in your policy, others might not be comfortable to deal with you, and they might also, like I mentioned before, have doubt about the financial information that you provide in your financial statement. Those data most definitely cannot be comparable neither between different years nor different entities. Thus, this standard makes it a point that if you want to change your accounting policy in the first place, make sure it is because the standards requires it. Any standards either due to amendments or perhaps requirements of a new standard. Or if you believe that by changing the policy, it will give a reliable and more relevant information than if you were to continue applying the old policy. Now again, remember that the objective of us preparing the financial statements is to provide relevant information for users of the financial statements to make the economic decisions. If we want to apply the effects of change due to the requirements of a standard that we want to apply for the first time, we must apply according to the specific transitional provisions of the standard, if any. Now basically, in applying every standard, entities will be given a transitional provision, a specific guideline on applying the standards for the first time, usually located at the end of the standard, if it has any. Therefore, not only that the transitional provision must be observed when applying the standard, but also when applying the relevant changes due to the applications of the standard. And if there is no transitional provision, the change must be applied retrospectively, thus retrospective application that we discussed earlier. Please note that these applications are subject to limitations stated in paragraph 23. How do we apply the changes retrospectively as in paragraph 19? Paragraph 22 states that an entity shall adjust the opening balance of each affected components of equity for the earliest prior period presented. Now there are two things here to be noted. One is the opening balance of any item of equity affected by the change. So we must first determine the item of equity that is affected, usually the retained earnings, and then adjust its opening balance. The other is the item should be adjusted for the earliest prior period that the entity deemed to be practicable. This is to ensure that the change is made as if the new accounting policy had always been applied. The adjustment shall also be made to other comparative amounts disclosed for each prior period presented. If you review any financial statements of companies in Bursa Malaysia, you will see that they provide not only the financial information for the reporting period, but also the year before. For example, if you are looking at the financial statements of financial year 2020, you will also be provided with the financial information for financial year 2019. This is for comparative purposes, and thus is called comparative amounts. So, what this provision is trying to say is, if you do the adjustment due to the change, not only that you need to adjust the value for the current financial year, but also the comparative amounts that you presented together with the current financial year. This is again to show as if the new accounting policy had always been applied. And again, please note that this application is subject to limitation stated in paragraph 23. Now, you might think that retrospective application is very tedious, required a lot of time and effort, and the standard must be insane to require that rigidly. You are right. And for some, it could mean going back 20 or 30 years. That does not sound very practical, isn't it? So the standard sets limitations on the retrospective application. Paragraph 23 states that the retrospective application should be applied to the extent that it is practicable to determine the either period-specific effect or the cumulative effect of the change. Paragraph 24 further explains that for period-specific effect, if it is impracticable to determine it for one or more prior periods presented, then apply the new policy to the carrying amounts of assets and liabilities as at the beginning of the earliest period for which we believe to be practicable, which could be the current period, and make a corresponding adjustment to the opening balance of each affected components of equity of that period. So the effect should be applied to the carrying amounts of assets and liabilities at the beginning of the period and the opening balance of the relevant components of equity of the same period. Similarly, for cumulative effect, paragraph 25 states that if it is impracticable, the new accounting policy can be applied prospectively from the earliest date practicable. That means we do not need to look backwards, thus prospective applications of new accounting policy. For accounting estimates, the effects of change shall be recognized prospectively, and the way we show the effects is by including it in profit or loss or income statement. But which period should the effect shown? It should be shown in the period of change if it only affects that period only, or in the period of change and future periods if it affects both current and future periods. And if the effect gives rise to changes in assets and liabilities or relates to an item in equity, the carrying amounts of the related assets or liability or equity must be adjusted in the period of change. For correcting errors, as identified earlier, it should be done retrospectively in the first financial statements authorized for issue after the discovery of error. And this should be done by retrospective restatements of comparative amount in the prior period presented where the error occurred, or if the error occurred before the earliest prior period presented, thus we need to restate the opening balances of the assets, liabilities, and equity for the earliest period presented. Again, we shall apply limitations, and for that we need to refer to paragraph 43 to 45. The limitations for retrospective restatement are more or less the same with retrospective application. Paragraph 43 states that errors will be corrected using retrospective restatement to the extent that it is practicable to determine either the period-specific effects or the cumulative effects of the error. And if it is impracticable to do so for period-specific effect for one or more period presented, then restate the opening balances of assets, liabilities, and equity for the earliest period practicable, which again can be the current period. That is paragraph 44. And in paragraph 45, it states that when it is impracticable to determine the cumulative effect at the beginning of the current period of an error on all prior periods, the entity shall restate the comparative information to correct the error prospectively from the earliest date practicable. So there you have it, the accounting treatment for effects of change in accounting policies, accounting estimates, and correcting of prior period errors, retrospective application, prospective application, and retrospective restatement, respectively. And for retrospective application and restatement, the effect should be shown in the opening balance of related assets, liability, and equity for the earliest period that is practicable for the entity. And if it is not practicable to apply new accounting policy retrospectively, we have the option to apply it prospectively.